So this is conventional absorption costing method. In this one, the OAR, the overhead absorption rate, will be budget overhead costs, will be budget overhead costs, you divide by budget labor hours. You divide by budget labor hours. So this one will translate to the overheads, the total, you take the total, which is 10,980,000. For the labor hours, you go to where information 4 is, where we are given the labor hours. American, we have 7 per unit times the units of American, according to the table up there, they are 900. Plus 5 hours multiplied by 800 plus 8 hours multiplied by 1,000 multiplied by 1,000. So work of that, I've saved me the figure. Work of that and send me the figure. Yes, June. I think I have to set a minimum of the answers I will work with. At least 2 people to respond before I proceed. Good, yeah. So June and Ivarine, that's good. So that is shillings 600 per labor hour. Is per labor hour. Then per unit, we start with American. If we start with American, you will say 600 times 1 American is taking 7 hours. So multiply that and tell me how much that is. Lois, I need to hear from you. McKenna, I also need to hear from you. Yes, June and Ivarine, 4,200. 4,200. Haya, huyu mwingine anaitwa butterfly. Butterfly. So butterfly 6 times 5. This one I can comfortably give you as 3,000. And then huyu mwingine anaitwa comfy. Comfy is 600 times 8. That must be shillings 4,800. Shillings 4,800. So with that, you are told to prepare the income statement. I hope my space will be enough. The budget, income statement. The budget, income statement. Budget income statement. So we will have details here. And these details, we will have revenue less prime costs, overhead costs, and net profits. The question shows prime cost as price costs, Trying to squeeze my space. We say less prime costs, again less overhead costs, and then net profits. Yeah, I can design it that way so that my space is enough. So revenue, which are less the prime costs, we less the overheads, and we get the net profit. So let's start with the American. Let's start with American. When you go to American, the units are 900. So the revenue will be 900 times, I think we can work with our figures being in thousands. Let's work with our figures being in thousands to make it a little bit easier. When you go to the selling price, it is 40. So multiply that. 40 times 900 is how much? That is 6,000. Good. That is 6,000. Then for the prime cost, it will also be 900 times the prime cost. You can see is that 5 times 35. Umepata gapi? Yes, Ivarin, Royce, good. That's 1,500. That's 1,500. Then for the overheads, it will be 900 times 4.2. 4.2 for the overheads. Okay, that's 780. That's 780. So give me the net profit now. Give me the net profits from there. What is the net profit? June nasema 630, Royce anasema 720. A third person. Ivarin 720. So June, recompute yours. It should be 720. 720. Yeah, good. And see, we're now together. So let's go to the next one, which is called butterfly. Butterfly. So butterfly, the units are 800. So it is 800 times the selling price. The selling price is 20. So 800 times 20 is how much? 800 times 20 is 16,000. Yeah, can see Joyce and Royce. 16,000. Then for the prime cost, remember prime cost is the total of direct cost. Is the total of direct material, direct labor, and any other direct cost. That is what we call prime cost. So this is 16. So 800 times 16. 800 times 16. Yes, karaoke can see 12,800. Yeah, Ivarin 12,800. 12,800. So the overheads will then be 800 times 3. This must be 2,400. So give me the net profit. Give me the net profit. The net profit, good. I can see 800. Let us go to comfy. Let us go to comfy. When we go to comfy, the units are 1,000 times the selling price is 30. So that is 30,000. I have then 1,000 times the prime cost is 24. So that is 24,000. Then 1,000 times 4.8. That is 4,800. So give me the Net profits. 1,200 from June and Ivarine, and also from Karaoke. 1,200. Now, the name of this company, or let's just call it company. For the company, we work with the totals. So add these revenues. So 36 plus 16 plus 30. 36 plus 16 plus 30 is how much? Yeah, 82,000. I can see from Ivarine, Royce, and June. 82,000. 82,000. Do the same for the prime cost. That 1,500 plus 12,800 plus 24,000. 68,300 from June. 68,300. Only June has given. I need one or two more. McKenna, I need also to hear from you and Helen. Yeah, Ivarine, get. So now give me the overheads. This plus this plus this. Check whether they go back to 10,980. Add them. Add those overheads. 10,980. So you see they go back to this one. 10,980. Add the profits now. Just a minute, or you already have added. Add the profits. 2720. Good. I can see 2720. Now, the examiner had not asked us to get the total here, but I put it so that when finally we'll be done with the activity-based costing, you'll be able to see that the two methods report the same total profit. But what happens is that the products will now report different profits. Utapata hii American haitakuwa na 720, hii haitakuwa na 800, hii haitakuwa na 1200. They will interchange, they will have different values, but finally all of them will add back here. All of them will add back there. So let's proceed to the next one. So the next one now is activity-based costing methods. Activity-based costing methods. So the first cost is processing services. We have processing services. Processing services. So in this one, we have the OER being equal to budget processing costs. You divide by this one. We can decide, we are not guided on what to use. So we can decide on which base to use. And I want to decide on or to settle on machine hours. I want to go for machine hours because processing is normally done using machine hours. So budget machine hours. So with that, I'm going to proceed and have the processing cost as 3,480,000. The machine hours we just argue the same way we argued with the other one. 4 times 900 plus 3 times 800 plus 6 times 1,000. So give me the OER there. Give me the OER. 290, sorry, shillings 290 per machine hour. Shillings 290 per machine hour. Per machine hour. So per unit, we are going to have American will have 290 times 4. How much is that? 290 times 4. Yes, Ivarin, 1160. June, good, 1160. Then we go to the next one when you're to a butterfly. Butterfly. Now butterfly will be 290 times 3. 290 times 3 will be shillings how much? Yes, Ivarin. Roy's 870. We have 870. Then Comfy, it will be 290 times 6. That will be 17 watts. 1740 from Ivarin. 1740. So let's go to the next assembly services. Let's go to assembly services. Assembly services. So the OAR here will then be equal to budget assembly costs. Budget assembly costs. Now this one we can go by assembly hours. That is labor hours. Budget labor hours. Budget labor hours. So this then translates to the cost. The cost is 2,562,000. So this will be 7 times 900 plus 5 times 800 plus 8 times 1,000. 8 times 1,000. Eight times 1,000. That is shillings 140 according to Royce. Yeah, also according to Ibrahim. So that is shillings 140 per labor hour. Per labor hour. Shillings 140 per labor hour. So per unit, when we start with American, it will be 140 times 7. 140 times 7. Yes, June. Ivarin 980. The same from Royce. Then butterfly will be 140 times 5. 140 times 5. Yeah, yes, I can see from Ivarin, Royce in June, 700. 700. Then Comfy, it is 140 times 8. 140 times 8. Yes, Ivarin, Royce and June, Helen, 1120. Shillings, 1120. So that is per unit. Let's proceed to the next. The next one is quality control. So quality control. So OAR will then be given as budget quality costs. You divide by budget what? Now this one, we can go by the production runs. Let us go by budget production runs. Budget production runs. So this one then becomes, the amount is 1,930,500. So the production runs, you get them like this. You can see in information number 3, we are told production of each type of sofa set takes place in batches of 50 units. So in the first one for the American, you will say it is 900, you divide by 50. That tells you how many runs that one will require. The next one, the same one, 800, you also divide by 50. You'll be able to know how many runs those are. And then, these are the one, 1,000, you divide by 50. Those will be the production runs. Those will be the production runs. Okay, June, Ivarin, that 5,750, also karaoke, that 5,750. And this is per run, per production run. So, per unit, if you want to convert it to per unit, when you come to American, you will take these that 5,750, multiply by the number of runs, which are 900 divided by 50. Then all this you divide by 900 units. All that you divide by 900 units. so that you're able to know per unit is how much. Per unit is how much. Yeah, I can see Ivarin, June, Wajogo, Royce 715, Shillings 715. Then butterfly, we do the same. Butterfly, we do the same. That it is 35,750 multiplied by 800, which is divided by 50. And then you divide by 800 units. You divide by 800 units. Oh, still 715, okay. Yeah, I can see those figures coming in. 715, and then comfy, it is 35,750 multiplied by 1,000, you divide by 50, you divide all this by 1,000. That's also 715. Okay, now you can get 715. 715. Okay. Then we proceed to the next. We proceed to the next, which is called selling and administration. Selling and administration. So the OAR will be budget selling costs, budget selling costs, budget selling costs, divide by budget. Now for the selling costs, I want us to write them by customer orders. Budget, customer orders, budget, customer orders. So this one is an amount of 3,007,500. You divide by the customer orders, which are 30, 40, 50. 30 plus 40 plus 50. Okay, I can see Varin, I can see June 25,062.5. 25,062.5 per order. That is per order. So per unit, American will be 25,062.5 multiplied by 30. You divide by 900. Multiplied by 30, you divide by 900. $835.42. Let's go for 0.42. 835.42. Units, shillings, 835.42. Then for the butterfly, it is the same. 25,062.5 times 40. You divide by 800. You divide by 800. Yes, let's confine ourselves to, or is exact. This appears exact. 1253.125. 1253.125. If it's exact, we can go with that. That is according to Farin. Someone else? Good. You will see the same. So we got comfy. Comfy, it is 25,062.5 times 50. You divide by 1,000. Divide by 1,000. Oh, still the same. 1253.125. 1253.125. So budget, income statement, budget income statement, budget income statement. I will have details. I want to avoid repeating the, so hii wacha nipanga namna hii. Selling price, you less prime costs, I think here I have a lot of space. I can do what should be done. You get contribution margin. Contribution margin. Then you say less overhead costs. Overhead costs. Now these overhead costs, we have processing. Huyu mwingine alikuwa anaitwa Sebre. Assembly. Ile ilikuwa naitwa assembly. After assembly tukaenda kwa mwingine alikuwa naitwa quality control. Quality. And then selling. Then profit per unit. Profit per unit. Total units. And then total profits. Total profits. Trying to avoid deleting this. But because you have the figures, you give me, let me not struggle much. You will give me the figures, or I'll tell you what to write. I'll tell you what to write. So that I don't struggle so much and you have the figures. So here I have American. I have butterfly. I have comfy. And then the company. Three. This is profit per unit. These are total units. And this is assembly. And this is selling. So that this is my prime cost. You finish drawing. Once you finish, you say finish. Maliza kuchora, you say finish. Once you finish drawing, you say finish. June, Varin. Helen and Royce finished. McKenna, you are so quiet. Okay. Let's start from here. We record the selling prices as they were. To avoid very many decimals because of those figures, let's work with the full figures to avoid very many decimals. So the selling price here is 40,000 with a prime cost of 35,000. So that gives us a contribution of 5,000. Contribution margin. This other one has 20,000 with a prime cost of 16,000. So we get a contribution of 4,000. Next is 30,000 with a prime of 24,000. So that gives us 6,000. Now, when you're doing per unit, you don't add to get for the company, not unless you multiply with the units. So upper, we will only come to add down here. You only come to add down here. So you don't add when you're doing per unit. But come to the to multiply in the units, then we have added like we did with the other. For the overhead, what we had, the figure for processing per unit. Yes, McKenna, good. Processing, what had we gotten? I think the OER was it 290? So 290 times what tumetumia, so 1160. Good. The OER was 290. Yes, good. So if you when we multiply tukapata per unit we got 1160. Then the OER hapa ikakuwa 290 times 3 tukapata 870. Then hii it was 290 tukamultiply na 6 tulipata 1740. Tulipata 1740. Good. Haya, for the what nimeacha moja? In my nilidhabu nikaacha moja na mwingine they were supposed to be 4. I hope you recorded all of them. After that, tukakuwa na assembly ikifuatwa na quality. Selling ikakuwa ya mwisho. Okay, so for the assembly, the OER tulikuwa tumepata 140. Na tulitumia assembly hours, so times 7. This one tuka record 980. Then 140 times 5 tuka record 700. 140 times 8 we recorded 1120. We recorded 1120. Quality, we had 35,750. 35,750 to multiply 900 divided by 50. And the answer to divide the 900, we got 715. Or is it equal to fanana? That's all? 715, eh? Yeah, good. June, 715 sorted. Apa 715 and 715. Then zeros are selling to kapata 835.42. Then 1253.125. Then 1253.125. So now give me the profit per unit. Profit per unit. Give me the figure. Profit per unit. Yes, Ivarin. Can see your answer. Royce, good, and they're in agreement, so I can record 1309.58. Before you move out of that, bring the units of American, they're 900, so multiply by 900 and check whether you record 1,178,622. Is that so? Yeah, good. Varin. Yes, Karaoke. Let's do the same to butterfly. To 4,000 minus 870 minus 700 minus 715 minus 1253.125. Send me the figure. Here's Ivarin. Here's Karaoke. You can see the figures are in agreement. 461.875 multiplied by the number of units, 800, and you record 369,500. 369,500. 369,500. Yes, June. Let's do the same with Comfy. 76,000 minus 1740 minus 1120 minus 715 minus 1253.125. Send me the figure. I'm getting 1171.875. So when I multiply by 1,000, then it will be 1171,875. Yes, I can see June, Helen, and Royce and Ivarin, we have agreed. Now, I say you only now add these ones. You only add the total profit. So let's add the total profits. And give me the figure. Yeah, I can see 2,719,997. Yeah, I can see June, can see Royce. So that is how you go about ABC. That is how you go about ABC. Now, tell me whether this profit is the one that we had gotten with the conventional method. Are they the same? Are the profits the same? Yes, Ivarin, I want the answer in terms of yes or no. Are they the same? When you look at them, can you say they are the same? McKenna says almost. The others, June says no. Royce says yes. Aaron says no. Now, these profits are the same. These profits are the same. Those who are saying no, it is simply because of 3 shillings, the difference of 3 shillings here. And that 3 shillings is brought about by this one. You see, this figure was rounded up, this one. That is where we have our 3 shillings lost. There. That's where we have our 3 shillings lost. And if you want to jog your mind kidogo, although this is not very important for the exam, if you take this times 30, ukisema 25,062.5 times 30, it is giving you 751,875. Then you take this 835.42 times 900, you get 751,878. and the difference is 3 shillings. Hope you can see that. Because of this rounding that we did here, remember this figure we rounded, it was not exactly 4.2. So rounding causes an error. So if you want to reconcile, ukiangalia hii tulianza nayo, this time this, it was 751,875. Then when you settle for this times 900, it is giving you this. So you can see the cost went up by 3 shillings. And when the cost went up by 3 shillings, profit had to come down by 3 shillings. You have icon 97. So if you are to return back the 3 shillings, then you will talk of 2720,000. So those profits are the same. So are we now in agreement? Helen, June, McKenna, and Ivarin. Is that understood? Okay. Yes, Helen, yes, Ivarin. June and McKenna. Now, the question is, yes, June, the question is, if you look at the conventional method, it was very simple and time effective. But the ABC has taken us a lot of time just to get the same profit total for the company. So some people would ask, is it necessary? Is it necessary? Now, if you remember what I had said earlier, we were to compare what we had gotten. You see, if you look at what we got earlier in the conventional, this one had a profit of 720,000. The other one had a profit of 800,000. The other one had a profit of 200,000. So that they add back to that. So you can see what I said, that they will report different profits. They will report different profits. I told you when we covered this, that the ABC method is the most accurate. Conventional, it has many errors. So given these two sets of values, these are the correct ones. And these ones are the incorrect ones. So the mistake that happens here is this. If you rely on this, if you rely on the conventional, for this product here in Ashida, you can see it was in a banana. It was in a banana. So that is irrelevant because they are similar. But for this one, you end up thinking that butterfly is giving you 800. And you put a lot of attention to it, while actually it is giving you 369. I know at our age, we have dealt with many people for different types of relationships. And there are people you have thought that they are very important to you and you have given them a lot of attention. Even you have done so much for them, only to realize they are not valuable to you. Or when it was your day, they looked backwards. Have you ever experienced such persons? Let me see. A person you thought they are valuable to you, you treated them so well, you did good things to them, only to come and realize they are not as valuable. Let me see whether you have ever come across such persons. Yes, good. Thank you. You must have come across them. So is that case here? You are paying a lot of attention to this one. Ukifikiria ndio inakuletea profit. Lakini haileti ni hasara. On the other side, you ignore this one. You see here inakuonyesha 720. But in reality, you're in a letter E. I'm also sure you have ever come across some persons who you never thought they are important to you, and you treated them casually. You at times even ignored. Later on to realize that those people are very good and very beneficial to you. I hope when you realize it was not too late. Was it very late? Yeah. Hey, talk to me. Was it very late when you realized that this person was very important, but you thought they were just useless? They were not beneficial. Oh, June, you are treated evil, okay? Okay. Yeah, these are realities of life. These are realities of life. And for this one, is a big loss. Let me start from here. It's a big loss, and you feel so bitter. You feel betrayed. You had given yourself free. You had committed yourself, only to realize there is no much benefit. But for this one, there is a probability of success. Because if this person has not yet realized that you are not giving them the required attention and they are still around, and you realize that they are beneficial before they go, then you have the opportunity to make up and benefit from this. But ukichelewa sana, and they also realize the same case here, utakuwa umepoteza. So that is what happens with products. That as a company, you pay a lot of attention to. You pay a lot of attention to a product that is not generating profits, and you ignore the one that is generating profits. You see, for this special program that we are running, you heard me the other day tell you that we will go by the quorum. That quorum, I'm the one who computed, and it is based on these things. And when I did the analysis of all our classes, I realized there are some classes we thought they are important, but they are not. We thought they are making money, that they are not. They are making huge losses. And there are others which we never thought they are doing well, but they are actually doing well. So we have decided to go by this. That's why the concept now is quorum-based. That's a practical example. Okay, I hope you have understood what I'm saying. Although your maneno yote, hiyo sio exam, hiyo ni a general life and learning business. But for the exam, you have to that. So are we okay with that? Let me not get into a lot of details. Are we okay with that? Yes, Ivarin. Yes, Royce, June, Helen, it. Okay, so let's proceed to the next question. Question 5A. So question 5A. So question 5A says, ACE Limited has two divisions, namely B and C, each under a divisional manager. The two divisions plan to acquire some investments in the month of August. So we are given the cost of capital, the current return on investment, the division's planned investments, and then for each of the two divisions, you compute return on investment and residual income. So the question is on performance measurements. Performance measurements. Performance measurements. So we have division here. So the first requirement is return on investment. Return on investment. And you know, return on investment is given as profit. You divide by assets. You divide by assets. You multiply by 100. That is what in brief or in abbreviation we call ROI. Then we have residual income. Residual income. Residual income. So residual income, you know it is profit. You minus cost of capital. Cost of capital, that gives us what we call RI. That's what we call RI. So design a table like that. So if you are finished, we are finished designing. For B, net profits will be 30%, so 0.3 of the revenue, 450,000, and the capital is 800,000. So multiply by 100. So give me that. Profit is the 30% of the revenue. So what percent is that? $16.875 according to Ibarin. Someone else to give me the figure. Yes, Royce confirms what Ibarin had. So we go by that, 16.875%. So for C, it will be 35% of the revenue, which is 210. You divide by 400,000 times 100 times 100. Yes, I can see June and Ibarin 18.375. 18.375%. 18.3. Let's go to the residual income. It should be 0.3 times 450,000 minus the cost of capital. Cost of capital, we are told, is 13%. So 0.13 times 800,000. 800,000. So tell me how much that will be. Yes, I can see June and Royce saying that 1,000. That 1,000. Then this one will be 0.35 times 210 minus 13% of 400,000. 400,000. $21,500. 21,500. Yeah, so hiyo tumemaliza namna hiyo. Let's quickly look at part B. TechServe Limited has several independent divisions. The company's tube division manufactures the picture tube used in television sets. The tube division's income statement for the year ended that 1st of March 2018, in which 8,000 tubes were sold, is given below. We have sales, cost of goods sold, gross margin, selling and admin expenses, divisional net income. The above cost of shillings 10.50 to produce a single tube consists of the following costs. We have direct materials, direct labor, manufacturing overheads, total cost per tube. The tube division has fixed selling and admin expenses of that 500 or 3.5. Now, Tech Survey has just established a new division called TV division that will produce a television set that requires high resolution picture tubes. The tube division has been asked to manufacture 2,500 of these tubes each year and sell them to the TV division. As part of determining the price that should be charged to the TV division, the tube division has estimated the following cost for each of the new high resolution tubes. We have direct materials, direct labor, variable overheads, and total costs. To manufacture the new tubes, the tube division would have to reduce production of its regular tubes by 3,000 units per year. There will be no variable selling and admin expenses on the intercompany business, and the total fixed overhead cost would not change. Assume direct labor is a variable cost. Now, you are told to advise on the lowest acceptable transfer price from the perspective of the tube division for each of the new high resolution tubes. So that question, question 5B, question 5B, it is from transfer pricing. And as you handle this, you will require to bring the knowledge of what we call special pricing decision. Special pricing decision. Special pricing decision. Special pricing decision. So in this case, you know so well, when we talk about transfer pricing, we normally have the company. And then we have who we call the supplier or the supplying division. And we have someone known as the receiver. So the goods are being transferred there. So in our case here, the company is the one going by the name Tech Survey. Tech Survey is the company. The supplier is the tube division. This is the supplier. And the receiver, this guy is the new division, is the TV division. So that is the background of the transfer pricing. We have the company here, we have the supplier and the receiver. And whenever we have been in transfer pricing, I've always told you a few things or some things that you need to know. One is that the transfer price is a revenue to the supplier. Number two, transfer price is a variable cost to the receiver. Number three, transfer price has no effect on the company. Number four, the revenue of the last department is the revenue of the company. The revenue of the company. But if the supplier had the external revenue, the revenue of the company will be the external revenue of the supplier plus the external revenue of the receiver. And I think we solved a question like that. And then the other point is the cost of the company are the cost of the supplier plus the cost of the receiver, excluding the transfer price. Those are the basics that you need to know anytime you see transfer price. From there, as far as special pricing is concerned, it will help you to come and say that the lowest acceptable transfer price, the lowest acceptable transfer price, obviously by the supplier, it should be equal to the marginal stroke relevant costs, of the supplier. When you see or when you hear of the lowest acceptable, it is the marginal, the relevant cost of the supplier. So the marginal, we need to get the variable costs. We need to get the variable costs of the current tube. So we need to get all the variable costs, and this is the way to go. So analysis table per unit of regular tube. Per unit of regular tube. Regular tube ni hii tuko nayo current. Per unit of the regular tube. So the first thing is the selling price. Selling price. So the selling price, as you can see, where you're given per unit is 1,700. 1,700. I'm leaving space here because there are some things that require some workings. The selling price is that. Then you say less variable costs. Variable costs. If you look at the cost of goods sold that has been broken down, the first variable cost is direct materials. Direct materials. Now, direct materials is 380. It is closely followed by direct labor. Closely followed by direct labor. Direct labor is 270. It is followed by overheads. Now, overheads, you can see, we are told 75 you're fixed. So the variable must be 25. So 25% of 400. 25% of 400 is how much? Yeah, I can see 100. It is 100. Then you can see there is after the cost of goods sold and the gross margin there below, we get selling costs. At those selling costs, we are told there is an amount that is fixed. So if you want to know the variable, you will argue like this. You will argue like this. You will argue like this. Using the figures in thousands, utasema the total is 3,900. Hiyo iko hapo juu 3,900. Alafu hapa chini tunaambiwa the fixed is at 500. So when you subtract, the difference is the variable component. Now that variable, you divide by the number of tubes, which we are told they are 8,000. You divide by 8. Yeah, good. I can see June and Royce giving me 50. So if that is what you have, then you get contribution margin. A figure called contribution margin. Contribution margin. Get a figure called contribution margin. Give me the contribution margin per unit of the regular tube. A unit of the regular tube. 900 according to June, also according to Karaoke, Ivarin, 900. Okay. From there now, let's seek to get the relevant costs. Relevant costs. Per unit of the new tube. Per unit of the new tube. Because we already know that the lowest price tunaulizwa, it is the relevant cost. And we also know so well that the variables are relevant. So down there you can see they have begun with direct materials. Direct materials. So direct materials is 600. Direct materials is 600. Then I have direct labor. Direct labor. Direct labor is 490. Then I have overheads. Overheads, we are told 2/3 are fixed. So the variable must be 1/3. So 1/3 of 540. The variable must be 1/3. 1/3 of 540 is how much? Yes, good. I can see 180. The next variable that we are supposed to bring is this one, this selling. But as per the words of the examiner, this new tube will not incur the variable selling. Somewhere up there we are told so, so we will not bring it. But what now we need to bring after that is lost contribution. Lost contribution. Because we are told that if you make the new one, you will lose 2,500 regular. And you remember the other day I told you, you don't look at your customers as human beings. You look at them as what? Let me see whether you remember. You don't look at your customers as human beings. You look at them as what? Yes, June, good. You look at them as money. Look at them as money. So when any customer is going away, then you know that is money going away. And that is very serious and very bad for your business because you have started the business to make money. And I said we look at it, we look at customers as money because we all love money. And therefore, we should love our customers and treat them well. So, what is going to happen is that for every regular tube we use, we will lose this money, this 900. So we are going to argue 900 times 900 times. Ukiangalia hapo juu, we are told we are going to lose 3,000 tubes. So that is the much that we are going to lose. That is the much that we are going to lose. But this one is being lost. Is being lost because we have decided to manufacture 2,500 tubes. So you divide by 2,500, Yojue, every one of the new one is making you to lose how much? Every one of the new one is making you to lose how much? Yes, June says it is 1080. Yes, Ibarine also agrees with June. 1080. Even Helen and Royce. Good. So with that now, we have the relevant costs. Total. And this total, it is our lowest price. Our lowest price. It is the lowest acceptable price. is the lowest acceptable price. So give me that figure. $23.50. You can say John, Royce, and Eric. $23.50. Okay. Finally, we are told, assume that TV division has identified an external supplier that could provide the high resolution tubes for only $2,000 each. And the tube division is willing to pay this price. Evaluate the effect of this decision on the profits of the company as a whole. So the effect on the company. The effect on company profits. Now this question is given minimax because the examiner expected you to work like this. The examiner expected you to work like this. You prepare a table, kama ile tulichora juzi. Na swali tulifanya kama hii ya transfer price, where you have the details. Hata ile tulifanya juzi ya Zambia na Kenya. You have the details here. Then you have two options. The current one where we are making, let me put it that way, where we are making. And then the second one is where we buy. So you get this one is the tube, this is the TV and the company. Tube, TV, and the company. You work out the figures, and then finally down here, you get the net profit. So in the profit utapata hapa, you compare with this one, and you tell us what has happened. That is what should have been done. But for us, because we understand these things so well, we will not take that direction. We will not take that direction. What instead we will do is that we know that if we decide to make this tube, we will spend material 600, labor 490, overheads 180, alafu tutapoteza contribution of this. But we will not pay an extra money to outsider. But if we decide to buy from outside, then we will not spend this on material. We shall not spend this, we shall not spend this, we shall not spend this. We only spend 2,000. Now, when I say we will not spend, it becomes a saving. In other words, we will make a saving of this much. We will make a saving of $23.50 per unit. But for us to make that saving, we must still pay 2,000 to someone else. So because this one is higher than the 2,000, our profits will go up. So we will simply come here and tell them, profits will increase by These savings, 2350, for you to make these savings, I've said you will have to spend 2,000. And this one is in regard to 2,500 tubes. So give me that. Tell me what that will be. $875,000 according to June. It's $875,000. And that's all for that question. So any question? June, you are very much okay. The others, are we okay? Aaron, Royce, Varine is okay. Okay, so we call it a day at that juncture and hope to pick up from there. Yes, Helen, that's okay. So we meet on Monday to pick up from there. Thank you. Yes, June, thank you.